Look how clean these highs are. See that? Look how it ran right up into it. That's not random. So even if you were looking at this price action right in here, all these wicks and stuff, I love that. I love when there's these wicks and convergences of tails and candlestick wicks together. And I have a bias and I have a draw on liquidity. You can enter in all that. What time frame is this right here? 1 hour, right? We're going to frame this. Now, if you start seeing all this back and forth in here and you see all these wicks, if you take that range here and we're on an hourly chart, we're going to look at this area in here and see what forms. Because in here, order flow is accumulating new longs. Algorithmic handshaking. That's what's going to happen here. Okay, and I'm going to show you what it looks like. Using that little shaded area in here, we're going to drop down into a 15-minute time frame. So the idea is the market's consolidating in here. It's consolidating with the expectation that it's going to allow for, quote unquote, smart money and their respective algorithms to handshake, dovetail together with what price is doing here. Everything is based on time, and when that price is in agreement with what you think it should be doing, drawing to liquidity, in this area here, we want to study how price is being respected around specific discount arrays. So what's a discount array? A down closed candle, the midpoint of a wick, any fair value gap, or volume imbalance. Right in here, we have this wick, so you want to measure half of that. We'll just eyeball it. We'll say it's right there. Nothing too clean here on that. Down closed candle here. What is this doing? What's this doing? We have this shaded area. What did I just show you on the Dow chart? How do we disqualify an order block? If it's trading outside of the range that we're specially focusing on, what is it doing here? It's outside of that shaded area. So am I going to look at that as an order block? No, I'm ignoring it. It's not there. So where's the down closed candle? There. What's the price level that's most important? The opening and mean threshold. So there's your 2 price points. In between the opening of an order block that's bullish here and mean threshold, there's your body, okay? Did this wick through the lower end of that shaded area that we're drawing our attention to? No. Does it wick above it? Sure it does. But we don't care about that. That doesn't disqualify this order block. From the opening down to the low, that's mean threshold. Between the opening to mean threshold, in that area, that's where your order block entry can be utilized. It's where you're going to focus your attention on and where your entry would be ideally taken. What I do and how I use it is I will enter at that opening price or as it smacks that candlestick's body. My stop is below this low here, and I want to see, does it respect the mean threshold? What can it do? Mohawk through it. So you have to be allowing that to happen. But look what it does on this candle. It opens, trades down, doesn't even touch the mean threshold of that candlestick's body, and then closes up here. What does that tell you? You're on side if you're long. Don't get shaken out of it. Reach for that relative equal high, these relative equal highs right there. See how clean that is? It's so pretty. It's perfect. Smooth edges, if you've never wrote it down in your journal, smooth edges like to be made jagged. Everybody will see this area here and say, oh, that's real nice. That's a resistance. And what are you going to put above that? Buy stop. Because traders want to see that as a breakout to go long, because that'll be what? Resistance broken. Or people that are short, that's where they're going to stop their trade out at. They're going to put their protective buy stop there. So that's where the market's going to reach for. And you see it doing it here. But inside these shaded areas, you can start breaking down price action a lot more refined than if you just simply ignored it, because it's a lot of wicks. Wicks scare people. To me, it draws attention. It's like sharks in water that's chummed. Wicks are like a chummed water. It's like an invitation. It's like a dinner bell for the sharks. Algorithms are going to go in there, and there's going to be a lot of algorithmic price delivery, or not price delivery, price entries with algorithms in this area. In this shaded area, that's what's going on in here. A lot of high frequency trading algorithms are in that business. And retail traders and the things that they try to use to trade with, they're getting chopped up because they're not seeing it the same way. In here, what is this? Inside this shaded area, what is occurring in here? That high to that low. That's our fair value gap, right? Correctly identified, right? No. What's this? Volume imbalance. You have to include that. What is that small little deviation below it? A mohawk. To get that low price, which is this closing value, which is 32,803, it's got to go below that over here. and that's 32,801. So 2 points below it. That factors a spread. So that way, to get this price booked for any algorithm that wants that price, the algorithm that books price has to offer that price and lower. Otherwise, the handshaking algorithm that the central banks use to fleece everybody that doesn't believe they don't exist. Okay, that's what's going on. Okay, that's exactly what's going on, folks. That's what makes these markets go up and down. That's the real dance. That high frequency trading algorithm entity that handshakes with this rigged market, that's what's going on every single day. All day long, every fucking day. Even on holidays. Even those little truncated times of the day or trading days when you can only trade till 1 o'clock or 12 o'clock and they cut the trading off. They're running then too. Their money never sleeps. But in these choppy points, these high frequency trading algorithms are chewing up everybody. And you think this is all noise. Because in that very moment, I'm in there taking trades. You will start seeing this when you start looking at it. But if you look at it as chop and you think, oh, this is going to harm me, or there's no rhyme or reason why price is doing what it's doing here, so therefore I should just don't do anything. You won't ever see it. You'll have a blind eye. You'll keep a blinder onto it. But everything's happening for a reason. It's all absolutely scripted. So once it goes down to the volume imbalance in here and trades down to this last down close candle, which is a bullish order block, here, we start to rally. Then we have, what is this? This is a down close candle, right? That's a down close candle, isn't it? Sure it is. What's the opening price on it? 32,834. And where does this candle go to? 32,833. 1 point lower. Why? Because to get that price, it has to drop low enough so the handshaking high frequency trading algorithms can get that price booking right on that opening.